Hey everyone, and welcome back to the Your Money Your Life podcast, episode 285 of the pod. Do me a favor, before we get into it, make sure you like, subscribe, five-star rate and review wherever you are listening to this podcast and or watching on YouTube. Today we're going to talk about a couple things. Of course, we're going to go over our market update. There wasn't much craziness in the market. It's actually pretty quiet, so that won't take us too long to dissect and go through. I do want to talk about something we are going to get to, which is the new bill that passed that has a lot of implications for families across the country. So we're going to talk a little bit about that and how that could potentially affect you, and one of the main things, highlights that you should look for in this bill, and again, how that can affect you. Let's first and foremost, as we do every week, jump into the market update. The market update is going to tell us what we want to hear, hopefully. First and foremost, last week it was a slow. Again, I said we're basically flat over the past 5 days. Nothing crazy in the market. It's been slow news time, not really much earnings, not really much data that's coming out about the market. If you look at it, we had earnings or we had inflation data that we talked about, but we've been, again, this whole year, we're still up 6% year to date, roughly. And it's been a regular moving year for the market, positive year for the market. The president did flirt with the idea. There was rumors, the idea that he would be firing Jerome Powell, the Fed chair. But then it was later dispelled that he wouldn't be firing him. The big thing for investors is what the Fed is going to do when it comes to rates in the coming months. Will they cut rates if they still believe inflation has been, taming, or that they have all the other check boxes hit? Will they begin to cut rates? That's the big thing that we'll be able to watch from the Fed. Other than that, the market's really just only was just dissecting that piece of information. Will the Fed chair Jerome Powell be dropped? And other than that, there was nothing much. If we're looking at it, um, we think that we'll see rates potentially be cut in September, October timeframe. July will probably stay pat. And that's what we're really seeing for the market. That's the indication is, everything looks, pretty fine. Inflation is getting better, and there is the bear case is drying up. And so it's really just, the fact that the housing market is in quite literal handcuffs, because again, rates are very high. 7% rates are high. So that's one thing to look at. It is July is, set to keep no change for the Fed. I believe July, no change for the Fed. And then we look at September, there's a smaller chance, but there's a, close to 50-50 chance of a cut in September, but more than likely October, we see that cut. You know, real estate industry, again, that's the area that, the Fed has to be watching now, because that seems to be slowing down. You have high interest rates, you have inflation that was cumulative for the past 4 or 5 years that has really hampered wage earners tremendously. And so, are they thinking about buying a house? It's a thing that a lot of people have pulled back on. Um, so that's the one thing. And then credit requirements have actually become more stringent as well. Banks, credit card companies, they want to become more stringent when lending because of the environment that they're in right now. They believe that charge-offs and paybacks not being received are increasing. And so those are issues that these lending companies have to deal with. So those are the kind of things that are the levers that are pulling at the general economy. But again, the market has shown positive and incredible resilience. That's what we've seen. We saw the rebound in April, and we're positive and we're hitting highs. The Nasdaq, I believe, hit new highs, and it should be the S&P as well, new highs as well, right? And so we're really in a strong place market wise. Have been for a while. Steady market, positive growth. That's what you want to be seeing. That's what you are seeing currently in the market so far. Let's jump into something else. Scale AI. This is a AI company, of course. They were, I think, acquired by Meta if not too long ago. I don't know if we announced it here or if we talked about it here, but Scale AI announced Wednesday it will lay off 14% of its global workforce just a month after Meta made a 14.3 billion investment and poached its CEO. The startup, which labels data units to train artificial intelligence models, will eliminate 200 full-time positions and 500 contract roles. That's a spokesman said. So they got an investment from Meta, lost their CEO, and they're saying, all right, we need to scale down. No pun intended, but Scale AI is scaling down. And that's not big news, but I think it's important to understand, what's going on in this AI race, in this AI universe. More tech news. Netflix is their pricing power is going to be tested. They're set to report second quarter earnings after the close today, if you're listening Thursday. And Wall Street analysts largely project upbeat results, which, Netflix is a company we've been bullish on for a while and has done really well. But they've been raising prices steadily. You all see it. We all have Netflix, and it's increasing prices. You get those notifications every once in a while. But given that Netflix no longer reports subscriber data, key areas of focus are expected to be the impact of the price increases, the growth of its advertising supported tiers, and the expansion of its international business. Revenue is forecasted to have climbed 16% to 11.6 billion in the quarter. And this is according to the average of analyst estimates. So, the big thing is going to be, will Netflix continue to grow despite increasing prices, despite all these different factors that are going on with the consumer? Will they grow? And that's a big question. I think they will, right? We'll see. They're going to roll out their numbers here after the close of business today, if I'm not mistaken. And again, I hate that they stopped doing the subscriber data, which is the key numbers that we want to see of Netflix is how much subscribers they have. Like that's a key to, obviously, they're integral to their business. That's probably the reason why they stopped rolling it out. Not a lot of the streamers do anymore. And that's something we'll watch closely, and we'll keep an eye on that. Larry Ellison, he's the co-founder and CTO of Oracle. He's now the world's second wealthiest person. This is according to Bloomberg's Billionaire Index. He has a net worth of 251 billion. He's 80 years old. He surpassed Meta's Mark Zuckerberg for the first time as Oracle shares price rally on investor demand for artificial intelligence stocks. The computing provider's shares have nearly doubled since April amid surging revenue and new partnerships. Last week, OpenAI reportedly agreed to rent an unprecedented amount of computing power from Oracle's data center. So these data centers, we see it in the video, the chips, data centers with Oracle, and then I think Google just had a deal that they made with OpenAI as well. People are using these data centers. This computing power is needed, and these companies are winning on the back of this new AI race. All the computing power needed to process all the prompts that you're putting in. If you go back upstream, you're seeing that a lot of these data centers, a lot of these chip providers are getting incredibly rich from providing that a much needed service and product. So that's something to keep an eye on. Great for him, I guess. And he's been rich for a long time, and it just milestone. I wonder if like someone like him keeps track of those sort of milestones. Does he even care? Does he even notice? It's all based on public information. He probably has private companies he owns or different things. Does he notice? Does he care? Probably not, but the world notices and cares. So that's congrats to him. Home loan demand just plunged 10%, ladies and gentlemen. We were talking about the consumer earlier, mortgage rates. The challenges of buying a home, from rising interest rates to an unpredictable economy, have dented the real estate market. Mortgage demand dropped 10% last week. This is reported by CNBC, as buyers and sellers have remained sidelined. And this is a 30-year fix. For the 30-year fixed, mortgage rates rose to 6.82% from 6.77%, increasing borrowing costs for buyers and disincentivizing sellers carrying historically low rates. Buyer applications dropped 12% for the week. So, again, there's two factors here. Of course, on the buyer side, they're looking at it and say, hey, higher interest rates. Do I wait? Again, people saying that they wait. I mean, waiting doesn't matter. It's either you could pay for your budget of the house that you want, or you can't. Waiting for for mortgage rates to drop, you could be waiting a long time, ladies and gentlemen. Like, have you ever seen a mortgage rate chart? You could be waiting a long time. And is that conducive to your family and what you're trying to do? Who knows? On the seller side, if there are people that bought before 2020 or in 2020, they may have lower rates and it's harder for them for existing home sales. It's harder for them to want to sell that because they don't want to they're locked in a low rate. They don't want to lock in another rate that will be much higher. So there's two factors on this, side of this, two sides of this coin. And yeah, it makes sense. I mean, you're seeing new construction versus resale inventory chart here. Um, and again, this people is stepping out of that market. We've talked about it before. What changes this? I think a few things, rates probably for some people that are thinking in that mindset. And also, just general, home price. Home prices aren't going to be going down. So I think people have to realize that. And or I don't believe so in anytime soon. They may stay flat, steady, especially in the luxury market. They're not going down. But folks have to just understand what they're doing for their family and if it makes sense to wait or if it makes sense to find something within budget that you can pay for, right? So that's the factors that you want to look at when it comes to this. And I think, that's the biggest stories of this week. The big thing we want to talk about in the roundtable, ladies and gentlemen, is the new bill. There was a bill passed that we haven't touched on yet, and what could it mean for you, for your family? Um, what are the big implications of this bill? I'll say the first thing is understanding there was a major piece of legislation this passed on July 4th. It's officially titled the Big Beautiful Bill Act, and it was signed into law. Um, it's not casual. There's a lot of things signed that are sweeping and ambitious. So people need to understand. One thing it does, extension of the current income tax rate. So the current income tax rates, the max individual rate, marginal rate is 37. It's made permanent. So a lot of times when presidents come in or new administrations come in, they change the tax rates because that's something that they ran on. They promised. In this situation, we've locked in and kept the tax rates, and the marginal top tax rate is 37%. Um, this one's not as important for people. I would say SALT deduction cap increase. So the SALT deduction is the deduction for state and local tax increases. So the deduction for state and local tax you deduct for state and local, and that increased from 10,000 to 4,000. It increases by 1% each year through 2029, after which it will return to 10,000. Again, something that may not be as applicable to people listening, but estate and gift generation skipping transfer tax increase. So estate, gift, and generation skipping tax transfer increase. The bill permanently raises the lifetime exemption amount to 15 million, 30 million for married couple, and will be indexed for inflation. Higher standard deduction made permanent. This will be crucial to mostly everyone, I guess. The bill increases and makes permanent a higher standard deduction, 31,000 in 2025, and 15,000 for most filers. So married filer joint, 31,000, and for single filers, 15,000. The senior deduction, beginning in 2026, taxpayers age 65 and older could take an additional 6,000 deduction intended to offset some Social Security taxation. The no tax on tips and overtime, the bill allows for above the line deduction of 25,000 annually for qualified tips by an individual employer contractor in occupation that customarily receives regular tips. The bill allows above line deduction of 12,000, 5,000 annually for married filing jointly for compensation of overtime. So this was really just a highlighted thing sent out by our CPA firm that broke down a little bit of what is going on in the bill. I think, for self-employed people, the big thing is the qualified business income deduction. It was originally due to sunset in 2026. It's now permanent. This locks in one of the most valuable provisions for S corps, partnerships, and sole proprietorships. But it does eliminate the importance of good planning, especially around reasonable compensation, aggregated rules, and specified service business limits. So permanent QBI deduction, that's good. The qualified business income deduction. So that 20% for sole proprietors, so as corps partnerships, is huge. It's been something that people rely or use a lot for being self-employed and get that large deduction. So that's huge. And that's something to note that it's still staying and it's made permanent. R&D deduction restored, changes to other things. So a lot of other minor things that probably don't matter to the layman person. But there are some things that, again, you just want to be aware of and how it affects you. You'll work with your CPA, work with your tax accountant, or if you do it yourself in the tax turbo software, you'll be able to see these new things come up. You'll be like, okay, I actually had a briefing on this. But good to know. You should good also make sure you know what's important for you in these situations, right? Reach out to professionals, especially CPAs. This is what they're supposed to be here for, there for, and they can help you as well to get this, kind of figured out for your family. Super important, super, super important. Folks, that's it. We had the covered the news, the market. We covered current news, and we covered the bill. So we did our thing. We did our thing on this morning. Make sure you subscribe, 5-star rating review. We do this every week. Share this with your family and friends. We will talk to you next week.